Welcome back to the desk. I'm Alex, and today we're looking at the latest sanctions enforcement actions from the UK, Q1 2026.
Under the 2017 amendments to the Policing and Crime Act, the Office of Financial Sanctions Implementation, or OFSI, is no longer required to prove a firm intended to bypass a block or even knew a violation was occurring. There were two recent enforcement actions. First, Bank of Scotland, a retail institution, incurred £160,000 penalty for screening failures during the onboarding of a personal checking account. Second, Apple Distribution International, operating a global B2B digital marketplace, received a £390,000 penalty for processing payments to a sanctioned app developer. Both are highly resourced global corporations. Both deployed sophisticated automated screening processes. Both relied on third-party risk vendors. And both authorized transactions that directly violated UK financial sanctions. This analysis examines a core operational vulnerability, the way automated systems can fail to detect the specific contextual shifts required to catch these high-risk edge cases. The size of a compliance budget yields no protection if the core architecture of the program relies on automation to solve complex edge cases under a strict liability regime. Between February 8th and 24th, 2023, Bank of Scotland processed 24 separate payments totaling roughly £77,000 for an individual designated under the UK's Russia sanctions regime. This animation shows the root cause of the initial failure. The designated individual opened the account using a British passport that contained a Cyrillic to English spelling variation of their name. The bank's onboarding algorithm evaluated the spelling against the official sanctions list, hit a character mismatch, and cleared the customer. The structural flaw here was an absence of commercial list enhancements. Bank of Scotland did not possess the proprietary databases that proactively map common Russian to English character variants, leaving the algorithm blind to the reality of translating between alphabets. The screening software performed its calculation correctly, but because the institution failed to manually calibrate the system for transliteration edge cases, they triggered a strict liability violation at the very first step of the retail pipeline. The automated defenses actually fired a warning shot. The day after the account opened, a separate automated screening tool flagged the customer as a politically exposed person, or PEP. A human reviewer commenced a manual media check 2 weeks later and successfully identified that the customer was on a sanctions list. However, the reviewer then incorrectly assessed the customer as being removed from the UK list, mistakenly believing they were only designated by the EU. This misjudgment persisted because of a procedural void. Bank of Scotland lacked explicit, mandatory instructions requiring analysts to escalate all potential sanctions connections discovered during routine PEP reviews to a specialized sanctions team. Automation can flag a systemic risk, but without rigid, explicit human escalation protocols, a complex compliance alert effectively disappears into a flawed manual assessment. Before we talk about Apple's sanctions enforcement action, if you like this type of content, please subscribe for more. Moving from retail banking to the tech sector, Apple Distribution International faced a similar architectural flaw, resulting in over £635,000 processed to a Russian media streaming developer named Oko. This chart diagrams the timeline of ultimate beneficial ownership. Oko was originally owned by Russia's largest bank, Sberbank. In May 2022, shortly after Sberbank was sanctioned by the UK, it transferred ownership of Oko to an entity called JSC New Opportunities. On June 29th, the UK designated JSC New Opportunities. Through June and July, ADI instructed their UK bank to process payments to Oko, legally making funds available to an entity wholly owned by a newly designated person. In corporate B2B pipelines, sanctions risks are highly dynamic. They evolve constantly, triggering strict liability the moment complex ownership structures shift to evade regulatory nets. ADI's defense architecture relied on two automated pillars: developer self-certification at onboarding and continuous monitoring from third-party due diligence data feeds. Those third-party vendor data feeds failed to detect the asset transfer. At the time of the breach, multiple open-source media articles clearly reported Sparebank's divestment of digital assets to JSC New Opportunities. The external due diligence tools never ingested or flagged these reports. Operating in a heightened geopolitical risk environment with Russian corporate registries withdrawing public information, ADI passively relied on automated vendor alerts instead of affirmatively demanding updated ownership documentation directly from the developer. Delegating risk assessment to a third-party vendor does not delegate regulatory liability. Passive reliance on external data feeds in an active conflict zone guarantees a strict liability breach. This comparative matrix illustrates the two specific failure vectors. On the left, Bank of Scotland failed at the static input stage, missing a static transliteration variable. On the right, ADI failed at the dynamic state change stage, missing an active transfer of corporate ownership. Both institutions committed the exact same operational failure, treating automated outputs and third-party vendor feeds as an absolute ground truth. Automation optimizes for processing efficiency. Strict liability heavily penalizes inaccuracy. Continuous, proactive manual oversight is the only mechanism that bridges the gap between the two. To navigate this reality, firms must implement affirmative, ongoing due diligence. You cannot wait for an algorithm to flag a risk. You must continuously force high-risk clients to proactively prove their ultimate beneficial ownership. That diligence requires strict human oversight. Escalation protocols must be explicit, ensuring human analysts immediately verify algorithmic edge cases against independent open-source intelligence. Because the strict liability framework captures any operational mistake, regardless of intent, enforcement actions are mathematically inevitable for high-volume processors. Recognizing this, the regulator actively incentivizes self-policing. Because they provided prompt, complete, voluntary disclosures of their operational failures, Bank of Scotland received a 50% penalty discount, and ADI secured a 35% discount. In any compliance regime, the ultimate test of a compliance program is not an unbroken, perfect algorithm. It is the speed of your human oversight and your uncompromising transparency with regulators when those algorithms inevitably fail.